Hello and welcome to Livewire Markets. I'm Ali Selby and today we're going to be learning how to invest $1 million in FY25. To do that, we're joined by two expert asset allocators in David Cassidy from Wilson's Advisory and Alex Ventelon from Morgan Stanley. Okay, let's get straight into it. David, I'm going to start with you today. What are the three most important factors that you believe will influence asset allocation and portfolio management in FY25?
Well, Ali, I think first of all, the inflation and interest rate debate is still central to how you think about investments over the next 12 months. So from that perspective, we're relatively constructive on particularly US inflation coming down and allowing the Fed to ease later this year. So from that perspective, that's a positive. Secondly, the economic growth and earnings growth outlook are going to be important. Still looks okay at the moment, but markets might be a little bit complacent about the resilience of the US economy, so that's sort of a neutral. And finally, valuations looking a little bit stretched in the US, so that has us a little bit cautious on getting too bullish on prospects for equities, particularly global equities over next year. So that's sort of leading us into a sort of fairly neutral view on equities at the moment.
Okay, over to you, Alex. Are your factors similar to David's? Which factors do you think will really influence portfolio management and asset allocation in FY25?
I would say that it's really very, very similar. I think from a macro standpoint, the policy, interest rate, macro sort of feedback loop between the three is the one that matters. We are of the view that inflation will continue to come down. It'll be a volatile journey, but we are expecting that in 2025, inflation should be back to target in the US. The Fed will see the signs of that realizing later this year, and we should be seeing interest rate cuts from the Fed following the ECB, which should be starting this week. So I think the policy backdrop will be very, very important, but it's dependent on the inflation backdrop itself, dependent on the macro backdrop. So we need this sort of flow of things to really work out very nicely. The other thing that we're watching is politics and geopolitical risk. They'll still be looming. They will be creating volatility all throughout this year. And then when we look at how does that translate into asset allocation, I think I agree with David, like valuations are still quite elevated. So it's a lot about what sort of earnings growth is going to come out of that.
You talked about the macro quite a lot there. How important is the macro to your process?
Look, macro is really the number one driver. We are top down by design. We try to get feedback from the bottom up as much as we can, but I think top down is the thing that works. We are research driven, so macro, economics, interest rates, that's what drives market over the long run. And that's how you build steady portfolios over the long run. So that should be your number one criteria in terms of forming asset allocation views.
Can the same be said for Wilson's? Are you also top down? And on top of that, is there anything that you think the market is overestimating or underestimating for FY25?
Yeah, I tend to agree with Alex. Cycle, as we call it, whether it's the economic cycle, the monetary policy cycle, we tend to put that top of the list in terms of formulating a tactical view, which for us is really somewhere between 6 and 12 months on the various asset classes. So I think that's the most important thing to get right. Valuation does matter, particularly when you start to extend out to sort of 12 months and beyond in terms of formulating views, but probably secondary to the cycle over the 6 to 12 month view. Then there's a whole grab bag of things we also consider: geopolitics, of course, sentiment, positioning, all those come into our tactical asset allocation views, but certainly the cycle, I think, is the preeminent thing to think about.
And in terms of the market overestimating or underestimating any risk right now, is there anything that you want to point out? Yeah,
I think market may be a little bit too hawkish on inflation, in the US at least. So from that perspective, as I said at the outset, we think we'll get some pleasant surprise on inflation over the balance of this year. But at the same time, even though we've been relatively constructive on the US economy for a while now, we're starting to see some signs the US economy is finally slowing. So maybe the market has adopted this no landing view right at the time when actually the US economy will be slowing down quite significantly over the next 6 months. Will that be a disaster? Probably not, but maybe the market could start to get a little bit nervous about the US economy over the balance of the year.
How about you, Alex?
Yeah, I think that's really, I think, what's going to be very interesting to watch in the weeks and the month ahead. To David's point, I think the market, and you can see that in interest rate expectations, it's been flipping around very aggressively. And you heard the term no lending a number of times in the past few weeks as the U.S. economy was outperforming and inflation was surprising to the upside. But clearly now, especially I would say in the last 4-6 weeks, we have seen a steep fall in U.S. economic surprise, so U.S. economic data coming in below expectations. And that is really, in my opinion, showing that we are finally seeing the sign of this lagged impact of monetary tightening finally kicking in into the real economy. PMIs maybe double dipping, retail sales depressed. We are seeing consumer sentiment as well being affected. So there's a number of indicators that are showing that the US economy is finally slowing. And what is interesting is, I want to say, be careful what you wish for, because we all want a cooler economic activity in the US. And you heard that term, bad news is good news, because we want softer economic data, we want softer inflation. But there will be, in the weeks ahead, potentially threats also that this cooling is now going too fast, right? So there is a very important dynamic between the cooling of the economy and the Fed cutting interest rates at the right moment. Otherwise, there will be fears of policy mistake. So that's really, in my opinion, what's going to drive a lot of the volatility, positive or negative, in markets in the month ahead.
We'll get into what that means for portfolio asset allocation in just a second, but just at a high level, I'd love to know what asset class you're most excited about for FY25.
Yeah, look, interestingly, I mean, if there was one, I think within equities, you can find a lot of interesting opportunities. There are underdogs within the equity market, and probably we've turned a lot more constructive. I'll talk just about the latest upgrade, which was on European equities. We know that European equities are trading at a very historically cheap level versus US ones, and the economy was quite depressed. And now we're about to get an ECB rate cut, most potentially this week. So we should see a rebound in European equity and in European economic activity. And we all know as well that of the main regions, it is the most exposed to emerging market, and the stabilization of growth in China, as well as the stabilization of the Chinese equity market, should be conducive to much better returns coming out of the European Union in particular. And so we should see a bit of a catch-up between European equities and US equities.
I'm sure a Parisian Olympics couldn't hurt as well.
Well, it's usually also something that can lift a sentiment quite well. European consumers tend to be depressed on aggregate, like the average is usually quite low, and these things can also help boosting, and hopefully more than for just 2 weeks.
Okay, over to you, David. What asset class are you most excited about for FY25?
Well, it's not usually an asset class that brings a lot of excitement, but fixed interest and associated income strategies, I think, look a lot more interesting than they have for some time. So from that perspective, yields have been going up now for a few years, and that's led to capital losses on a lot of fixed interest strategies. But from these levels, with a view that the US economy is probably going to be slowing from here, we think fixed interest looks interesting. And also related to that, floating rate credit strategies with high interest rates around the world, including Australia. There's quite a bit of income on offer in floating rate strategies, various funds offering 7-8%, in private credit land more like 9 or 10. So that income side of portfolios, I think, looks a lot more interesting than it has for a while.
Okay, I'm going to get into your tactical asset allocation now. Alex, you're slightly overweight alternatives. What kind of alternative strategies are you using, and how do you even define alternatives?
Yes, thank you. I think it's always an interesting debate. I think that there's no very strict definition, but our definition is basically anything that is not just long only one asset class. So in alternatives, what you'll find is hedge fund strategies, including long, short, market neutral, global macro, etc. You'll find also commodities, and you will find also private markets. So we put in there private equity, private debt, and private real estate. So that's our sort of a definition of the world. For the asset class that are long only, we are looking at the private markets. So that's the sort of the bucketing. So they will have risk-return characteristics that are very different to the one you get in traditional bonds or equities. Now, when it comes to what we like within the asset class, we have been long-term supporters of hedge funds at the forefront, and we have retained these very constructive views on hedge funds. Now it's a very broad market, so we are talking about hedge funds that are the ability to go long and short within asset class. So what we like is relative value, market neutral, or even long short equities. One strategy we like particularly is, for instance, within small cap, we have a long short small cap strategy, which we think is really ideal right now because we are seeing green shoots in small caps with companies trading at historical low, but at the same time, there are still some pretty heavy macro headwinds. So a long short manager will be the best place to harvest alpha from both ends. We continue to like private equity, but within private equity, we've been very sort of concentrated onto secondaries, as we knew there was a lot of activity in the market and the ability for managers to clip good tranches at steep discount. And now we are seeing the conditions evolving towards a better backdrop for traditional private equity. So we are back a bit more into private equity. The last one, and it's currently everyone's favorite, is private debt. We do like private debt. I think you can get a phenomenal income from those strategies, but you have to be really careful when picking your manager and picking your underlying markets, because we know that also it's one area where these higher for longer rates are now starting to impact very negatively the asset class, and we're seeing defaults emerging in some categories. So manager selection is paramount in the asset class.
Do you have any tips on that? And in terms of underlying markets, what do you typically prefer?
Look, we like a diversification of, we like diversified strategies. So we like managers that will have extended number of lines in their portfolios. We like managers evolving in markets where they genuinely have an edge. We like managers as well that have been through also several cycles and several also debt restructuring exercise, because they will be able, if any default occur or non-performing loan happen, they will be able to find better ways and a better outcome out of that. So I think this is what you need to look for, and I think also a good diversification between Australian and global markets, because the Australian private debt market, although growing fast, remains quite a small market.
Okay, over to you, David. You're also slightly overweight alternatives right now. Does your definition of alternatives differ from Alex's, and what kind of strategies are you using in this bucket?
No, fairly similar, I think, Ali. Private equity, private debt, what we call uncorrelated hedge funds. So we don't want to use hedge funds overly that are just giving you additional exposure to directional moves in the listed markets. And private infrastructure, private or unlisted property, and also commodities, I guess, is another area we do invest a little bit, particularly gold. So pretty similar, I think. Obviously, the private markets allocation within alternatives is pretty large. So investors often need to be able to accept a little bit of illiquidity, but we think there is still a illiquidity premium offer for investors who can take a longer term view. So we're still pretty excited about what we're seeing in the alternative space, particularly the private markets area, and we're a little bit overweight.
Are there any types of strategies that you're most attracted to right now?
No, I think, as Alex said, diversification is the key. So we're still seeing selective opportunities in private equity that we still like. Private credit, but once again, I agree that manager selection's very important. We actually quite like the Australian private credit or private debt markets. We think the inbuilt protection for the way lending works in Australia is a little bit stronger than the US in terms of, as a lender, you rank probably a little bit further up the tree than the US. And we're seeing selective opportunities even in things like unlisted property, still seeing quite good IRRs on offer in the mid-teens. So, across the spectrum, still think there's plenty of return to be had, and can also decrease portfolio risk, which is pretty important.
Speaking of decreasing portfolio risk, you're also overweight fixed income right now. As you talked to before, you said you're quite bullish on that asset class in FY25. Can we get a little bit more granular into where you're seeing opportunities within fixed income? It's obviously quite a big asset class.
Yeah, well, I think we have an allocation to, I guess, what we call, core bond managers who typically invest in, relatively high quality bonds, government bonds, semi-government bonds, and investment grade corporates. We think at this particular time in the cycle, that hasn't been a good place to be, as I said, over the last few years. But we think US inflation coming down, US growth slowing, the Fed cutting. Normally fixed interest performs well into a Fed cutting cycle. So from where we are now with 4.5% 10-year US Treasuries, we think on balance they'll be lower by year end. So you should make a capital gain there, plus pick up that starting income.
So would you be locking in those yields now?
Yeah, I think so. I think the other thing it does do is, if your equity portion of your portfolio runs into trouble, not to say it will, but if it does, you should be able to make a capital gain there. So that's why we like that allocation. On the satellite side, as I said earlier, Aussie floating rate credit looks good with the cash rate at 4.35, looking like it's not going anywhere till well into next year. Managers that can access that base cash rate plus a spread, and spreads are still quite decent in Australia, to us look a pretty good place to supplement that core fixed interest allocation.
Over to you, Alex. You're also overweight fixed income right now.
Yeah.
How are you allocating within that asset class?
Look, admittedly, we have been overweight bonds for a while, and maybe a bit early when it comes to the duration call. But as David said, I think, in the end, bond yields follow the trajectory of growth, inflation, and central bank interest rates, right? And that's what matters in the long run. And we are, in our view, in a world where both growth and inflation are decelerating and central banks are going to cut. So it's all green lights for government bonds from here. So we like having a good chunk of the portfolio covered by government bond. Gives you good income, as David said right now, but also this downside protection, I think, is really paramount. One thing that was interesting is back 2 years ago in 2022, there was a lot of debate around the depth of the 60-40 portfolio because both bonds and equities fared extremely poorly during the year. And I think maybe this year is the year where we see a bit of the inversion of that, right? Where both bonds and equities are doing well because interest rates are and inflation are going to come down. So I think for investors, it's not a bad place to be right now. You can be well invested into equities and into bonds as well. So we like those government bonds as a hedge, as a carry instrument. We also find a lot of value in floating rate debt. I think Australia in particular has this wide range of floating rate instruments, and you can scale that on the level of risk that you want to take, which is always very interesting for investors. We like specifically floating rate notes and sub-debt here in Australia. In the US, in terms of the corporate bond market, we have a bit of a barbell strategy. We are seeing an improvement in the fundamentals of the loan market, so we have a small exposure. On the safer side of things, we find a lot of value in shorter dated US corporate bonds, which will benefit from a fall of yields at the front end of the curve, while still yielding about 5.4% right now.
Okay, let's move to growth assets now. And David, I'm going to start with you. Your tactical asset allocation is tracking pretty much the same as your strategic asset allocation when it comes to local and global equities. How are you actually investing in both those areas of the market?
If we go back a little bit, we had a more favourable allocation, or more positive allocation to both global and Aussie equities start of last year. We've been sort of trimming into strength, particularly in global equities recently. Maybe a little bit too early, but we're just thinking that even though we're not bearish on the macro, we think that valuations, particularly in the US, are pretty full. I don't think the US is in a bubble, but it's hard to see PE ratios going higher. I think the risk is somewhat asymmetric there, that they either stay where they are or go lower. And from that perspective, we think we have to get more conservative in terms of potential return expectations for global equities over the next 12 months. So what that translates to within a portfolio, taking the allocation back down to neutral, probably a bit less allocated in US equities or growth style managers than we were maybe 6 to 12 months ago. Putting in a little bit more value into portfolios, a bit of small cap exposure, edging back into that trade as well. So yeah, rejigging both the tactical view and also what's in the global equity bucket. Within Aussie, we're not too excited about where the index can go in terms of the bank sector and to some extent the resource sector dragging on growth potential in terms of earnings growth. So we're being quite active. We invest directly as well as with managers in Australia. So we've been fairly active around the benchmark in trying to generate some alpha, because we don't think the index, while we think it'll go trend higher over the next year, we don't think returns are going to be spectacular. So we're trying to be quite active in Aussie equities.
In terms of global equities, we've seen a little bit of froth once again. I mean, GameStop has once again shot to the moon. Would you be using passive strategies for global equities or more active strategies?
No, we always try and be relatively active. It's just we're changing the types of active management exposures we have. As I said, a bit less growth than we had a year ago. So we always tend to be active, but we do blend styles in particular, and we're just sort of shifting those styles as growth continues to surge and valuations get stretched. We're taking a bit off the top.
Okay, over to you, Alex. You're underweight Aussie equities, which I'm sure our audience will be a little bit disappointed by, but you're overweight global equities right now. How are you allocating there?
We're around neutral on equities overall as well. And really we have a pretty sizable overweight in international equities, which more or less matches the underweight we have in Aussie equities. So it's been a big tilt. That's been evolving quite dramatically, but maybe in the last 6 to 12 months, our view was that the market would continue to be a very narrow market, concentrated around the winners of what could be perceived as secular themes, in terms of maybe AI is the most well known, but there's also a lot of things happening within pharma, etc. And so a lot of these were what we consider to be or referred to as quality company, and the US has a lot more of that compared to Australia. So it was fairly obvious to us that the action will happen mostly in US market, and it would continue to do so. Fast forward to now, I believe, as David said, I think valuations are a bit punchy. Where we might differ a little bit is that although we have a small allocation to value, we're not yet convinced that this shift is really going to happen. I think from a long-term perspective, yes, value, small caps offer fantastic opportunities. In the shorter term, it's hard to see in a decelerating environment for us the impulse for that to be doing much better. But the jury's out. We'll see. It's a very difficult market to manage. I think what is most interesting for us is to look into markets such as Japan and Europe, where we see stronger earnings growth from here, and the starting point in terms of valuation is a lot more interesting. So in terms of region, Europe, Japan, India, for the more adventurous within emerging markets, something we've been pushing for more than 1 year now. And when it comes to Australia, Look, I think the issue for Australia is the lack of high quality stock as per the definition of the quality bucket. We don't have many of these or as many as the US here. We also have a monetary policy setting that is likely to stay tighter for longer compared to the US. And also we think that the banks have run pretty hard and it makes an environment where at the index level, the future gains will probably be decent, but hard to keep pace with the opportunities that there are in global equities. So we are still positive on Aussie equities on an absolute basis. We're just more positive on global equities.
Okay, we talked a lot about the asset classes that you're both really liking today. I want to know what you're avoiding, what you wouldn't touch in FY25. David, I'm going to start with you.
Yeah, well, I'm not really sure if it's an asset class, but Bitcoin, I'm still a little bit of a skeptic there. So from that perspective, you hear a lot of commentary around Bitcoin being a good diversifier. If you look at the history, it really hasn't been. It's really a risk-on asset. So I think it's, in a lot of ways, looks like the NASDAQ. So from that perspective, I think if you've got a US equity portfolio, you've got enough exposure to that theme without going into Bitcoin. So we're not really playing that one.
Do you have many clients asking about Bitcoin?
I think it's correlated with how well it's doing. So in the months and quarters when it's doing really well, the inquiry rate goes up, and in times where it's pulling back, probably less of an inquiry level.
How about you, Alex? What asset class would you not touch at all in FY25? Bitcoin's already been taken, so you want something else?
No, but look, there's one thing probably that is worth mentioning, that I think Bitcoin is getting more and more a good gauge of risk appetite in markets. It's been very interesting as an indicator for the type of money going into markets, I think. Look, we still very much watching the property market, commercial property. We're seeing defaults, a lot of companies struggling to refinancing. We know in the US, there's trillions due to be refinanced, probably more than 2 trillion before the end of 2025. And so there's a maturity wall. And we know that the regional banks were very active in terms of providing this funding to commercial real estate in the US, and these regional banks are still restructuring themselves. So I think that we don't think it's a systemic risk, but we think that it's a sector that will continue to go through a certain number of troubles. Now, if you look under the hood and if you're quite selective, and we can find in terms of stock ideas as well, there are opportunities, because away from the traditional retail and office sectors, there are other sectors in industrials, in data centers, etc., that offer really compelling opportunities. So you just got to be very, very selective. And I think it's still too early to go back into the traditional commercial real estate sector.
I want to ask about cash. Both of you are sitting on 2% cash right now. David, I might start with you. What does that indicate about your outlook for markets being pretty much fully invested?
Probably not that we don't recognise that cash looks, more interesting than it has for some time, but just that we think taking a little bit of extra risk in areas like, as we mentioned, both floating rate credit in the public markets or private credit, you can get a pretty nice spread over the top of cash. So you don't have to take a lot more risk to take that 4.35 cash rate up to 7, 8, 9%. So from that perspective, we think there are income opportunities out there that are a little bit more interesting than cash at the moment.
Can the same be said for you, Alex?
Exactly. Yeah, exactly. I think you given we're still in a relatively sound economic environment, the pickup you get from going into floating rate credit notes is really interesting. So there are opportunities. Right now it's a market where there's plenty of opportunities to deploy money, and it's good to have cash as an option to fall back on, and maybe we will use that option later in the year as volatility picks up again. We don't know, but right now, if you look at your sort of risk-return trade-off, it's probably sitting at the bottom of the ranking in terms of the major asset class.
And looking out over FY25, is there any mistakes that you think investors are likely to make?
It's hard to say because there's still a lot of uncertainty in this market. To us, it still looks like a market that is late cycle, and we could be through the soft landing, going back on the cycle clock, but probably into the expansion phase, not the recovery phase. So going back to mid-cycle, right? So because it's very hard to know exactly where we are, because also the willingness of the central banks is to cool economic activity. So economic activity will fall. It's never, as a consumer, it's never a pleasant environment, right? So there'll be a risk, and I think the main risk is to get carried away. Right, is to get carried away because you mentioned GameStop, we mentioned Bitcoin. They are speculative assets that are very well bid right now. So I think there are flows of speculative money getting back into the market, and that's always a sign that you need to stay cautious. So I think you need to stay invested, but you need to stay invested in quality assets. Deploy the money, average in, don't get carried away. And I think you'll be fine. If you chase the return into very speculative, low earnings area, then you're probably a lot more at risk in the next 12 months.
Okay, over to you, David. Is there any advice that you would have for investors over the next 12 months so that they can be truly successful?
Risk assets are always walking a fine line between, are things too hot, are they too cold? There's always going to be volatility. I expect volatility does pick up over the next 12 months as returns moderate. So from that perspective, there's going to be weeks and days when you wake up and feel pretty bearish about the world. There's going to be times where you feel pretty bullish. So I think stick to a long-term strategy. I do think the US election is going to be even more interesting than it is typically. I think US seems fairly bullish about the prospect of a Trump victory.
Yeah.
I think they're using the playback from the last term when equities did quite well up until COVID. So it was actually a good news story for US equities. I'm not sure if that's going to be the case this time around. When I look at the size of the US deficit, I look at the fact that inflation, even though we think it's coming down, is still going to be pretty high if he does take office in November. I think what he's proposing is not great for inflation in terms of tariffs.
Yeah.
It's not great for the US deficit in terms of cutting taxes again. So even though I'm bullish on bonds now, I'm a little bit worried about what Trump could mean for the US bond market next year. Equities probably won't focus on that until next year, but just tucked away in my back of the mind is Trump, if he does win, may not be as a good news story as he was in last time around for stocks and bonds in the US.
Well, thank you so much for your time today, guys. That was such an interesting chat. I really appreciate you taking the time to share your asset allocation and tips for investors in FY25.
Thank you.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.